Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi there. The long-term capital gains tax on equities is a reality, not just on shares, but even on mutual funds, your mutual funds, my mutual funds. So I thought it's probably a good idea to get familiar, to get acquainted and find out exactly how this tax is going to be levied. So we need to keep the NAV in mind, and let's take a look at a very, very simple example to understand how this goes. So for the sake of our example, we have taken a mutual fund and we've taken 2,000 units. Now, the NAV on the original buying date, which is the May 1st, 2017 for our case, is 100. Now, the cutoff date is 31st of January 2018. And for this particular case, we have decided to take a higher NAV, basically assuming the fund did well and the NAV moved to 160. We then went on to redeem units. Basically, we decided to sell out, redeem our units a whole year later, which is the 2nd of May 2018. Also note that these particular cases that we are taking, we are assuming that the NAV on the 31st of Jan is higher than the original date at which you invested in the mutual fund. So therefore, these are those examples. Now, assuming 2,000 units, the original investment was 2 lakh rupees, simple multiplication, 2,000 units into the NAV on that day. As of 31st of Jan, this investment swelled up to 3.2 lakh rupees. And when we redeemed, by the time we decided, okay, let's take the money home, the actual investment was worth 4 lakh rupees. That was the capital appreciation. How do you now calculate capital gains tax liability? This is how it's going to play out. Now, the first rule is a very simple one. We always have to keep this in mind. Capital gains are going to be calculated based on the higher of the two, either the original NAV or the NAV of the fund on the 31st of January. For this particular example, the 31st of Jan NAV is the higher one. That's why it's highlighted in the red color. So how do you do this? Very simple. The total gain or the total value of the investment was 4 lakh rupees. You subtract that by the total value as of the 31st of January, you're left with 80,000. But hey, there's good news, right? Because 1 lakh rupees of capital gains are exempt. That's what the finance minister has offered. So since we have that exemption of 1 lakh, 80,000 is less than 1 lakh, you actually don't have to pay any capital gains tax in this particular example. Now let's move on and see what happens when you've made even more money in the equity market. How does the taxation change then? The next example, again, at the beginning, your NAV is 100. It moved to 160 on the cutoff date. When you redeemed, the gains were even higher, even a better market, a huge bull charge. So your NAV after a year turned into 220. What's going to be sort of the case over here? Original investment was 2 lakhs. It moved to 3.2 lakh on the 31st of January 2018. By the time you redeemed, it was looking even better at 4.4 lakhs. So how does the tax calculation work now? Very simple. Your final value, the actual value was 4.4. The cutoff value, the 31st of Jan value, since that was the higher NAV, was 3,20,000. So the total capital gain that you've made, 1,20,000. But again, hey, good news. Remember that 1 lakh rupee exemption. So you knock off that. What you're left with is just 20,000 rupees on which you have to pay tax. The tax is at a rate of 10%, which means the actual outgo is 2,000 rupees. Simple enough, right? Now, these were examples where we were assuming that the 31st January price was higher or the NAV was higher. What happens if you're in an adverse market scenario and your original investment price is higher and the cutoff NAV is actually lower? So let's take some examples here. Original NAV 100. By the time you reach the cutoff date, it dips. The fund actually underperforms and the NAV falls to 90. However, you still hold on and you redeem only after 1 whole year. And then there's a pickup in the market again. So your NAV, which dipped to 90 because of the market rally, moves back to 200. So now how do you look at the calculations? Once again, original investment 2 lakhs. It dipped with the market to about 1.8 lakhs. But by the time you redeemed, you were back at 4 lakh rupees. Now look at this very, very carefully. Again, you have to take the higher of the two. In this case, what's higher? The original date at which I invested in the fund, the original NAV is higher. So I need to take that as my benchmark price. which is why my total gain or the total value, which is 4 lakh, I have to subtract the original investment 2 lakhs from that, and I am left with the capital gain amount of 2 lakh rupees. That's how much I've made in the market. But since I have that 1 lakh rupee exemption, I can simply knock off the 1 lakh. On the residual 1 lakh, I will pay tax at the rate of 10%, which means 10,000 rupees is going to be my tax outgo. Let's take a look at one more example, a fourth case in this scenario. Again, original NAV 100, we're assuming the market dipped, so 31st of Jan, the mutual fund level went down. 90 was my NAV there, but I remained patient. I wanted to wait for a market recovery, which did happen. However, not that great, not as good as the previous example. So finally, my NAV after 1 year was 120. I decided to redeem out. Now what happens? Again, we have to go with the higher NAV date, which is the original date at which I invested. In this case, my final value when I redeemed the mutual fund was 2,40,000. I subtract my original investment amount, which was 2 lakh rupees from that. My total capital gain is 40,000. However, good news here again. Remember, you have that 1 lakh rupee exemption limit, which means there's no case of any capital against tax outgo since you're within the 1 lakh rupee limit. However, my friends, this is where the good news is pretty much kind of ending, because now finally, before I wrap out, I'm going to run you through some very, very important things that you must keep in mind when you're looking at this new LTCG calculation. What is this? Point number 1. You have to go scheme by scheme. This was just one example. Now, you in your portfolio might have 4, 5, 6, 7 funds. You have to calculate tax liability on every single fund, and all put together, your total exemption for 1 year is 1 lakh rupees. Not just mutual funds. The total exemption includes shares and mutual funds. So if you're buying and selling directly in equity shares, that along with your mutual funds, the total capital gains that you can earn tax-free, long-term capital gains, is 1 lakh rupees. Over and above that, everything gets taxed. So keep that in mind. Very, very important. Another important thing to keep in mind is that, of course, while you're calculating this, you'll have to take a look at your overall portfolio, as I mentioned, both stocks and your mutual funds, and then come to a sum total, though individually you'll have to calculate on an individual scheme basis and individual share basis. Last but not the least, some people had this a question when we put out a previous clip on social media. You can set off losses. What's the good news here? That now that there is a long-term capital gains regime, in case you have a long-term capital loss, that loss can be offset against your long-term capital gains tax liability. So that set off is now allowed, which wasn't the case earlier. However, what it does mean is that there's a fair amount of arithmetic that you have to do. So get your papers and pens out, make sure that your portfolio is in front of you, and look at these calculations on a per mutual fund scheme basis. That's it for now. Thank you for